$10,000 invested at historical market rates should produce a massive accumulation of wealth, but that capital faces structural erosion that drains its potential. This chart tracks the loss. The market return reaches $469,000, but active mutual funds stop at $145,400, a $323,600 shortfall. Supplying 100% of capital and risk, the investor receives only 31% of the reward. Intermediaries siphon the remaining 69%, risking nothing. Vanguard founder John Bogle spent his career deconstructing this discrepancy. He rejected the idea that successful investing was about finding the right stocks. Instead, he focused on the mechanics of modern equity markets to identify exactly where this capital leaks out of the system. Investing is a mathematical equation governed by frictional costs. In this environment, attempting to beat the market becomes a negative-sum game for the people who provide the capital. Economist John Maynard Keynes defined market returns as a combination of two distinct forces, enterprise and speculation. Enterprise is the fundamental reality of corporate value creation. It consists strictly of dividend yields and earnings growth. Speculation is the change in the price-to-earnings multiple, essentially the fluctuating amount investors are willing to pay for $1 of those earnings at any given time. We can see these forces in the historical record. From 1900 to 2005, the total nominal return on U.S. stocks was 9.6%. Enterprise accounted for 9.5% of that return, the result of a 4.5% average dividend yield and 5% annual earnings growth. The remaining 0.1% was speculation. These erratic spikes represent moments of intense confidence or fear, but they always eventually return to the baseline of business reality. Over the long run, active trading and speculative shifts cancel each other out. Investors cannot earn more than the intrinsic value their businesses generate. To explain the logic of the market, Warren Buffett uses a parable about the Gutrocks family, who collectively own every stock in America. This network models that reality. If investors collectively own 100% of corporate America, they must collectively receive exactly 100% of the gross market return. Before fees, beating the market is a zero-sum game. Outperformance by one manager is matched by underperformance from another. The dynamic shifts when we add intermediaries. These nodes intercept capital flowing to investors, taking a percentage of every transaction. These intermediaries extract their fees, regardless of whether the trades they facilitate actually produce a positive return for the investor. Once these costs are deducted, the aggregate investor pool earns less than the market itself, shifting the logic of the system into a negative-sum game. This waterfall chart tracks exactly how that market return is whittled away. First are the explicit fees. The average active fund has an expense ratio of 1.5%, and amortized sales loads add another 0.5%, removing a full 2% from the total. Then there are the hidden costs of turnover. A fund that replaces its entire portfolio annually incurs roughly 1% in brokerage commissions and bid-ask spreads. Finally, we account for cash track. Funds holding 5% in cash to manage redemptions lose another 0.3% in potential yield in a 10% market. Over several decades, these deductions mean an 8% gross market return becomes a 5.5% net return for the active investor. While compounding generates wealth over time, the recurring pressure of these costs works with the same mathematical persistence to reduce the final accumulation. We can map this against the data from 1980 to 2005. While the S&P 500 grossed 12.5%, active funds netted only 10% in nominal terms. When we apply the historical 3.3% inflation deflator, we see the real purchasing power of those returns. In real dollars, index funds yielded $76,200, while active funds yielded just $40,600. The active investor captured barely half the available real profit. The data reveals a secondary leak: the divergence between a fund's reported time-weighted returns and the dollar-weighted returns actually experienced by human investors. This is driven by pro-cyclical capital allocation, investors adding cash after a period of strong performance and withdrawing it after a crash. During the tech bubble of the late 90s, aggressive funds reported cumulative returns of 112%, but because of poor timing, their average investor actually suffered a 4.5% loss. Human emotion consistently moves capital at the wrong moments, buying at the peak and selling at the bottom, which further expands the wealth gap. High turnover also creates tax liabilities. In a taxable account, active trading results in an estimated 1.8% annual tax burden, compared to 0.6% for a static index fund. Finally, we must look at dividend capture. This chart shows the 1.8% gross dividend yield corporate America generates. When an active fund applies its expense ratio, it takes the majority of that yield. The investor is left with a sliver of just 0.3%. A low-cost index fund leaves nearly the entire dividend intact, delivering 1.65% to the investor. The high turnover model used by active managers results in consistent tax liabilities for the investor, while the operating overhead effectively removes the baseline dividend yield. Despite the arithmetic, many investors believe they can avoid these pitfalls by studying past performance to find a winning manager. This table shows the flaw in that logic: survivorship bias. Of the 355 equity funds that existed in 1970, 223, or 62%, simply went out of business over the next 35 years. Statistical randomness dictates that if enough managers flip coins, a handful will flip 10 heads in a row. It is easy to mistake this luck for skill. Over a 50-year timeline, the mathematical probability of a passively managed index fund outperforming an active portfolio is 98%. By simply holding a diversified, cap-weighted index fund that represents the entire corporate sector, an investor removes these friction points entirely. This strategy is increasingly necessary. Historical returns were bolstered by a long-term expansion in valuations. If future returns are lower, fixed costs will consume an even larger portion of an investor's wealth. Achieving the full return of the market requires minimizing frictional costs and allowing the intrinsic growth of corporate enterprise to compound over